One of the last topics we look at in the first semester of intermediate accounting are the impairment rules. And they will depend on whether it's a fixed asset or an intangible. So the impairment rules for held for use or held for sale, we're looking at tangible operational assets and finite life intangibles, meaning if it's finite life means I can estimate the life. It is tested for impairment only if specific events occur or changes in circumstances occur. Now, the IFRS rules are going to differ just a little. So how am I handling my tangible operational assets? I'm depreciating them. I'm depleting my natural resources. I'm amortizing my intangibles if I can estimate the life, if it has a finite life. I do not impair it. Impairment rules for indefinite life, meaning I have something that I cannot estimate the life. Now, the rule for Goodwill is different. We'll talk about that in a minute, but this should be tested for impairment at least annually. So if I have an asset, I can figure out depreciation. I know the cost. I know the residual value. I know the estimated life. I use depreciation. But if one of those do not exist, I cannot estimate the life, then I do not depreciate because I can't guess. So instead, I test it for impairment at least annually. Goodwill, that should be tested for impairment at least annually. And it has it's similar, but there are some little different rules. So first of all, assets held for use or assets held for sale. If you're using it, you're not going to sell it. The impairment, it's very subjective. It can be subject to some unethical business practices. So a test for impairment occurs when circumstances indicate the book value may not be recoverable. So what does this mean? It means I bought an asset for $100,000. I've depreciated $50,000. The book value is $50,000. But because of the current economic conditions, it's not worth $50,000. Then I may be able to record some of that through impairment loss. That is, if the fair market value, because of economic reasons, is lower currently than the current book value, then I can record an impairment loss. If it is held for sale, this is different. You have to evaluate book value to current fair value when you make the decision to sell. If the fair value is below book value, you record an impairment loss plus any cost to sell. So it's going to increase the loss besides just the impairment. Regular depreciation is stopped if an asset is held for sale. So if it's held for use, I continue to depreciate it. If circumstances arise, the economy declines drastically, and I feel I need to record an impairment, I can, but I still get to continue depreciating after the impairment. With held for sale, I'm no longer to continue depreciation. Fair market value is sometimes hard to determine. We often use the discounted future cash flows to determine fair market value, and we'll talk about fair value hierarchy in class. Present value calculations of expected future cash flows are sometimes used. So the impairment actually has two parts under U.S. GAAP. There is the test for recoverability. This is analysis of undiscounted future cash flows. And the reason it's undiscounted because FASB wanted to make this sort of an easier test. You just look at future cash flows, but you don't have to discount those amounts to what they're worth today. If it's less than the current carrying value, the impairment loss must be recognized. Carrying value or book value. Then you calculate the impairment loss. Here, you do have to discount those future cash flows. So the test, FASB wanted to be an easy test, but the actual calculation takes a little more because they want that to be accurate based on discounted future cash flows. And you have to add the cost of disposal if it is held for sale. So the impairment calculation, differences. If you're still using it, you're not going to dispose of it. You don't have a cost of disposal. So there is just the key differences, very small, between held for use and held for sale. You're going to write down the asset. You're going to continue depreciating the new cost if it's held for use, but you stop if it's held for sale. Under U.S. GAAP, restoration is not permitted, meaning reversal is not permitted if it's held for use. It is if it's held for sale, because you want it at its current value if it's held for sale. Keys to remember: the test for recoverability uses undiscounted future cash flows, but the calculation of impairment loss, fair value if you know it. If you do not, you can try to determine it through discounted future cash flows. Now, the IFRS differences, under IFRS, they have two different methods. They call it the cost model and the revaluation model. The cost model, this is the traditional historic cost, less accumulated depreciation, less impairment. Revaluation model, once chosen, you have to reassess it every year. So that's been one of the resisting points of FASB in adopting this IFRS model in the convergence project. If you choose the revaluation model, you're really babysitting your assets every year. It's a lot more work for your accounting department. You have to reevaluate depreciation every year. You have to spend a lot of time analyzing, wow, am I using the correct method? Should I be using an accelerated method? Reversals are allowed under IFRS, where they are not under GAAP, unless it's held for sale, except for goodwill. Here are some other key differences with IFRS. Losses go on the revaluation losses go on the income statement. Revaluation gains must go into other comprehensive income under IFRS. And with impairment, because you are allowed to use reversals, you have to zero out OCI first, and then it comes from the income statement, affects the income statement. And that is considered currently to be the biggest difference between FASB rules and IASB rules with the convergence project. Reversals of impairment forbidden for goodwill. Other IFRS differences, it's terminology. Under GAAP, we call it a reporting unit. Under IFRS, we call it a cash generating unit. Under GAAP, you can impair something for a segment of a component with discrete financial information. With IFRS, it cannot be just one department or a segment. With GAAP, again, it's a two-step. You test for impairment and then calculate it. With IFRS, it's just a one-step calculation only. Reduce goodwill first, then reduce other assets. So what about goodwill? Well, the rules are different. Goodwill is a unique intangible asset. The costs are not directly associated with any specific identifiable right. It's not separable from the company as a whole. So this is probably one of the hardest parts. Fair value must be implied. It cannot be measured directly. You have to evaluate the fair value of the entire company and then kind of back into what goodwill is or how it changed from year to year. Then next, you evaluate fair value of the known assets. And actually, the theory is, even though you will see corporations with large amounts of goodwill, the theory is that eventually goodwill will always be impaired off the books. The change in value of the goodwill is implied. It cannot be measured directly. So, and what do we mean by this? We're going to go through an example of Blue Corporation. They acquired all the stock of Green Corporation for $600 million. And remember, goodwill only exists in the accounting records if you purchase another company. You cannot generate internally and record goodwill as an asset. Even though in theory goodwill exists, you cannot record it as an asset. Okay, now the appraised value of the net assets is $500,000. So what does this mean? The net assets are worth $500 million. But because It's such a good company, I'm willing to pay $600 million. As a result, the goodwill is $100 million. Now, at the end of the fiscal year, Blue Corporation performed an impairment test of Green Corporation, finding the book value to be $540 million, including $100 million of goodwill. So remember, the value, I paid $600 million, the book value is $540. Okay. On that date, the fair value of Green Corp had dropped to $460 million, and fair value of all identifiable assets, excluding goodwill, was $435 million. So you have all the information you need. You just have to know where to begin. All right. Step 1. Test for recoverability. Because the book value of the net assets of $540 exceeds $460 fair value of the reporting unit, the impairment test indicates an impairment loss is required. So the test was passed, positive. Now I need to calculate it. Okay, how much? It's not as simple as you might think at first. You have to determine the implied goodwill. So the fair value of Green, $460. The fair value of the net assets excluding goodwill, $435. Implied value of goodwill is $25. Measure the impairment loss. Book value of goodwill is $100,000 or $100 million. Implied value is $25 million. So my loss is $75. Goodwill impairment requires an annual testing for impairment. No reversals are allowed under U.S. GAAP. No reversals are allowed under IFRS either. Here's one area where we're consistent. IFRS reversals are only allowed for other operational assets. So again, to review U.S. GAAP, it's two-part. You test it with undiscounted. It's just a simple test. FASB didn't want to complicate things and make you discount it first. But then if that is positive test and you do have to impair, you have to use discounted. And those are the impairment rules.